If you are holding gold or silver right now, or even thinking about it, what I am about to show you should worry you and excite you at the same time, because the numbers coming out of Washington this week are not just bad. They are the kind of numbers that historically come right before a much bigger move in precious metals. Stay with me till the end, because in this video I am going to connect three things that most channels are treating separately: the bond market, the oil market, and the trade data, and show you why they are actually one single story about how this economy is being managed right now. Before we go further, if this kind of independent, no-spin economic breakdown is useful to you, do me a favor and hit that like button, subscribe if you have not already, and turn on notifications. It genuinely helps this channel reach more people who need this kind of analysis instead of the noise you get elsewhere. My name is Alex James, and this is Macro Bullion, where I break down gold, silver, and the broader economy as an independent analyst. No party loyalty, just the data and what it means for your money. Today's topic is simple to state but heavy in consequence: the state of the U.S. economy under the current administration, specifically the trade numbers, the energy price shock, and what the bond market is now telling us. This is not a political video. I am not here to defend or attack any party. I am here to walk through verified government-sourced data from the Bureau of Labor Statistics, the Energy Information Administration, and Treasury market data, and let the numbers speak. Here is the background you need. Over the past year, the United States has been running an aggressive tariff policy alongside a military standoff with Iran that has directly disrupted oil flows through the Strait of Hormuz, one of the most important choke points for global oil supply. At the same time, the Federal Reserve has been trying to manage inflation while the government has been spending heavily and issuing enormous amounts of debt. All three of these forces are now colliding, and the collision is showing up clearly in trade prices, energy prices, and long-term borrowing costs. This is the setup, and in the next, I will get into exactly why this has become a genuine problem, not just for Wall Street, but for the average American household and for anyone holding hard assets like gold and silver. Verified data, no spin. Let's continue. Let's start with the trade numbers, because this is where the tariff story gets tested against reality. According to the Bureau of Labor Statistics, U.S. import prices fell 0.4% in July 2026, following a 0.3% decline in June. That sounds like good news on the surface, cheaper imports. But look closer. Export prices fell 1.3% in July, after already falling 0.7% in June. That means American goods are becoming less competitive and less valuable on the world stage, exactly the opposite of what tariff policy was supposed to achieve. And year over year, import prices are still up 5.9%, meaning the underlying cost pressure has not gone away, it has just shifted around. This is verified BLS data, published this month, and it tells a story of a trade strategy that is not delivering the results it promised. Now here is where it gets more serious. Energy. Import fuel prices actually fell 7.2% in July, but that monthly drop hides a much bigger and much worse yearly trend. Over the past 12 months, import fuel prices are up 25.2%. Petroleum and petroleum product imports are up 26.3% year over year. And natural gas imports, the number that should genuinely alarm every household, are up 74.3% over the past year. That is not a rounding error, that is a structural energy shock, and it is directly tied to the ongoing conflict with Iran and the disruption of oil traffic through the Strait of Hormuz. This background matters because the administration chose to escalate rather than de-escalate that conflict. As of this week, Brent crude is trading above $91 a barrel, and WTI crude is around $85 to $86 a barrel, both up sharply from earlier in the year. President Trump has stated that the Strait of Hormuz is open and that mines have been cleared, but shipping data continues to show attacks on vessels transiting the strait, and traffic remains well below pre-conflict levels. So there is a real gap between the official messaging and what the verified shipping and price data is actually showing us. That gap is the background you need to understand before we get into why this has become a genuine economic problem, which is exactly where we are headed next. So here is the problem, and I want to state it as plainly and fairly as I can. When you combine an aggressive tariff regime, heavy government spending, and an unresolved military conflict that is disrupting global energy supply, you get a very specific and very dangerous combination: rising costs with no clear resolution in sight. This is not a partisan opinion. This is what the bond market itself is now pricing in. Look at the 30-year Treasury yield. This week it topped 5.31%, the highest level in 19 years since June of 2007, right before the global financial crisis. That is a massive, verified move, confirmed by CNBC and Treasury market data. Strategists at Barclays have pointed out that this rise is driven less by traditional inflation fears and more by concerns over the U.S. budget deficit, heavy government debt issuance, and rising term premiums, meaning investors are demanding more compensation to hold U.S. government debt long term. In plain English, the market is starting to lose a little bit of confidence in how the fiscal situation is being managed. This is the real problem, because when the 30-year yield rises this fast, it ripples through everything: mortgage rates, corporate borrowing costs, and the overall cost of capital across the entire economy. And it is happening at the exact same time that oil-driven inflation risk is climbing because of an unresolved war that this administration chose to enter and continues to manage through economic strangulation tactics against Iran rather than a negotiated resolution. Even people who are generally sympathetic to the administration's economic messaging, including voices on networks that have traditionally been supportive, have started acknowledging this. Energy officials themselves have conceded uncertainty about when oil traffic and prices will normalize. That kind of admission from within a sympathetic media environment is itself a signal worth paying attention to. When your own allies are flagging flashing warning signs similar in tone to what was seen before the market stress of 1987, that is not something an independent analyst can responsibly ignore. So, to summarize the problem fairly, without exaggeration, we have rising long-term borrowing costs, a trade policy that is not delivering promised competitiveness gains, and an energy shock caused by an ongoing and unresolved geopolitical conflict. Individually, each of these would be manageable. Together, they are creating real strain on the broader economy, and that strain is exactly why gold and silver have been behaving the way they have. Let's get into that content and analysis next. Now let's bring this back to where macro bullion lives, gold and silver, because this is where all of that pressure is actually showing up in real tradable prices. As of August 20th, 2026, gold is trading around $4,495 per ounce, after briefly touching above $4,500 earlier in the week. That is up more than 34% compared to this time last year, according to Trading Economics data. Silver is trading around $63 per ounce and has surged more than 76% over the past 12 months, with some data providers showing gains north of 150% depending on the measurement window. This is verified, real-time market data, not speculation. Why is this happening? When long-term treasury yields spike the way we just discussed, it would normally hurt gold because gold does not pay interest, and investors could just buy bonds instead for a better return. But that is not what is happening here. Gold has been holding near its highs even as yields hit a 19-year high, which tells us something important. Investors are more worried about the underlying fiscal and geopolitical instability than they are attracted to the higher bond yields. That is a classic signal of a market that is losing some trust in the stability of the system itself, and it is exactly the kind of environment where gold and silver historically outperform. Add to that the Federal Reserve's own internal debate. Minutes from the Fed's July meeting, released this month, showed that some policymakers actually argued in favor of raising interest rates this year to prevent sharper inflationary pressure later on. That is a meaningful data point. It tells us the Fed itself is worried that inflation, driven partly by this energy shock, could accelerate. And all eyes are now on Fed Chairman Kevin Warsh's remarks at the Jackson Hole Symposium for further clues on where policy goes from here. So here's the analysis in plain terms. You have a trade policy that is not delivering, an energy shock tied to an unresolved war, a bond market flashing a 19-year high in yields, and a central bank privately debating whether it needs to raise rates to fight inflation it did not fully expect. That is a genuinely unusual combination, and it is precisely the kind of environment that has historically pushed capital toward gold and silver as a hedge against both currency debasement and policy uncertainty. This is not me speculating. This is the verified data from the BLS, the EIA, and Treasury markets all pointing in the same direction. Now let's talk about where this could go from here. So what does this mean going forward? Based on everything we have covered, verified trade data showing weakening export competitiveness, a major energy shock tied to an unresolved Iran conflict, 30-year Treasury yields at 19-year highs, and a Federal Reserve internally debating rate hikes to contain inflation, I expect continued volatility in both directions for gold and silver, but with the underlying pressure still tilted toward higher prices over the medium term, as long as this combination of fiscal strain and geopolitical uncertainty remains unresolved. The U.S. Treasury has already responded by announcing it will more than double repurchases of 10, 20, and 30-year debt in the coming months, specifically to try to bring long-term borrowing costs back down. If that effort succeeds, it could ease some of the pressure we are seeing in yields. But if the underlying deficit and spending trends continue, and if the Iran situation stays unresolved, I would expect gold to keep testing new highs, and silver, given how much more volatile and industrially tied it is, to potentially see even sharper moves in either direction. I want to be fair here and say this plainly. This is not about attacking any political figure personally. It is about looking honestly at verified government and market data and recognizing that the current combination of tariff policy, war-driven energy disruption, and heavy deficit spending is creating real, measurable strain on the American economy. Strain that shows up in trade numbers, in bond yields, and ultimately in the price of gold and silver on your screen right now. As always on this channel, I am not a licensed financial advisor, and nothing in this video is personalized financial advice. These are verified data points from the Bureau of Labor Statistics, the Energy Information Administration, and real-time market data presented for your own analysis. Please do your own research, DYOR, before making any investment decision, and consider speaking with a licensed financial professional if you need personalized guidance. If this breakdown helped you see the bigger picture behind the gold and silver moves, hit that like button, subscribe to Macro Bullion for more independent, data-driven economic analysis, and let me know in the comments what you think happens next. Do we see gold push through new highs, or does the Treasury's move to buy back long-term debt bring some calm to this market? I will see you in the next one.